Dipti ji, we are good to go.
All right. So good afternoon, everyone. I'd like to welcome you to the first financial seminar hosted by SEVA, the Outreach Committee of Hindu Temple. It gives me great pleasure to introduce the speakers for this afternoon. We have Spencer Stone Jr. He's the Senior Vice President, Senior Portfolio Manager, and Financial Advisor for USB Global Wealth Management. He's a founding member of Summit Wealth Management Group. He also serves as the branch manager of the Sylvania branch of USB. UBS.
All good.
USB is the port. Oh, Dipti. Okay. He was prior to joining UBS, he was a senior VP, financial advisor, and portfolio management director at Morgan Stanley. He began his career in finance at Kidder Peabody. We also have David Mieti. Mr. Mieti is the executive director at UBS. In his role as the executive director, he's the wealth planning strategist. His expertise is in wealth planning and trust consulting. He has over 38 years of experience in wealth management and trust administration. Also joining us is David Carter. David Carter is an attorney with Eastman & Smith in Toledo. David's expertise is estate planning, trusts, and probate. Prior to joining Eastman & Smith, he worked at one of the leading financial institutions where he earned his designation of Certified Trust and Financial Advisor. Now let's give them a big Hindu Temple of Toledo welcome and listen to their expertise. And if we have any questions, you can either post them in the chat and Bhupesh will relay them to the speakers and they'll try to address as many of them as they can. Thank you.
Dipti, thank you very much. We are honored to be here. Thank you for your time. And thought we would talk about three primary things this afternoon. One is financial planning. The other is estate planning. And the third element is planned giving. And when we think about financial planning, we think about how do we bring people together for a purpose. I always have said that there are three key elements to a sound financial plan. Number one is purpose. Oftentimes we find that clients will have a financial plan, but it may lack purpose, meaning why does a family or an individual have a financial plan? So we oftentimes begin our dialogue with purpose, the reason behind the plan. Why is the plan being created? And what is it that's important to our clients to incorporate in the plan? So key number one is purpose. Number two is communication. Oftentimes we find clients have a tax advisor, they may have an investment advisor, they have an estate planning advisor, they might have an insurance advisor, and all too often the advisors work independently of one another. There isn't much collaboration, there isn't much communication. The important thing to keep in mind about a financial plan is that a financial plan needs to incorporate not only purpose, but it needs to incorporate all of the other elements of our clients' financial lives. In other words, the other elements need to dovetail into each other to work together in harmony. And all too often we find that the communication element is lacking. I think the third element we look at is execution. Some questions that anyone really should ask is, do they have the right advisors on their team? Is the advisor proactive? Does the advisor communicate? Does the advisor bring new ideas to the table? Does the advisor work well with others? And so big picture, as we begin dialogue on financial planning, purpose, communication, and execution. And I think that the initial discussion really needs to hinge on the purpose. We like to have, and we advise that our clients meet with all of their advisors in one room at least once a year. And what that does is that promotes communication. It promotes dialogue, and it promotes the discussion around purpose. And again, bringing all the elements together. Something that everyone should think about as we dive into a solid financial plan, and a financial plan really should be looked upon as the foundation of your financial picture. If you think about building a house, it's very important to have a foundation. And as we've worked together with clients now for 2-3 generations, really the issue over time becomes not so much the money, but the consistency and continuity of a plan. Will the plan continue? Does the purpose of the plan change? Yes, but will the plan continue should something happen to, say, the matriarch or the patriarch? And hopefully our clients can say yes, because the plan has been completed and the foundation has been poured, there's continuity to the plan. And there are, of course, other elements to that as well. But something that everyone should consider in their plan are 3 basic foundational aspects as we dive into this a little bit today. One is a liquidity and income strategy that clients have. What we mean by that is liquidity. How much to keep in short-term liquid assets to meet income or emergency needs or purchase needs. So what is the liquidity strategy? What is a liquidity plan? And how do you build structure around that? And I'll come back to these 3 points in a moment. The second is longevity. How to best position long-term growth assets. So stocks, right? Equities would be considered long-term growth assets. We have clients who invest in private equity, which is riskier, not as liquid. So longer term growth assets that are riskier, not as liquid, longevity. And then third is legacy. And we'll spend probably most of the discussion today with David Mietti and David Carter on legacy planning. Legacy really incorporates estate planning, but also plan giving. What is the best manner by which to gift, period, to a charity, to an organization? And of course, tax laws change, and tax laws make giving perhaps in some years easier than others. But I think overall, if we look at financial planning always begins with purpose. What is the purpose behind what's being done? We've found that a lot of people will engage in financial planning and perhaps even pay a lot of money to do it. But the plan itself doesn't mean anything because the dialogue didn't begin with purpose. Why is the plan being created? Oftentimes, financial plans aren't successful because there isn't adequate communication between the advisor and the client or the client's other advisors. Again, meeting once a year. And then execution. Always great to have good ideas, but if the ideas are not being executed upon, it makes it very difficult to follow through. Estate planning, and really good estate planning, is detail oriented. And oftentimes lots of T's need to be crossed and I's need to be dotted. And so, as a result, detail is critical. So I think as we look down the list of the purpose, communication, execution, the 3 elements that we focus on are: number 1, liquidity. What is a liquidity strategy in your financial plan? How much cash and liquid assets should you have at any one time to meet emergency needs? The number 1 probably question an issue that I address with clients is ensuring there's sufficient liquidity to meet income needs and not have to sell good investments at a bad time. There's nothing worse than having to sell good investments at a bad time because perhaps the market's down and a client might need liquidity for income. I always say that's on the advisor. The advisor has not done their job if you're selling good investments at a bad time. A good advisor will work in advance of that. And I always have said that's on the advisor's shoulders. But I think as we look at the three elements of a good plan, a liquidity strategy, number one, a longevity strategy, number two, how much to allocate toward long-term growth assets, and a legacy strategy. I think for today, we'll focus a bit more on the legacy strategy, which is estate planning, plan giving. Oftentimes, and typically around tax season, clients will ask us what's the best manner by which to gift to, say, their church or to a school or to a museum. Should we just write a check? Should we just pay cash? What about gifting stocks? What about a bigger picture strategy where we have a number of families who've actually set up a foundation? What does that look like? Why would you do something like that? What are the costs involved? So as we dive into David Carter's presentation on the basics of estate planning, and then we're going to dive in a bit to David Mietti's discussion on very specific planning opportunities and strategies, I think everything must begin with purpose. It must begin with honest dialogue about why a plan is being created. What is the purpose? What's really enjoyable about what we do is we work with a lot of different families, all of whom have different needs. We have clients who have set up special needs trusts for their children. We have other clients who have taken care of their parents through trust. There are a lot of different areas and elements we can focus on, but I can't emphasize enough the focus on purpose. It needs to have a good financial plan, needs to be purpose driven. Lots of communication, good execution. And as hard as this might be, I think we always encourage clients to evaluate team members, right? Is your team the A team? You know, certainly as a client, you want to make sure that your advisors are the A team. They're doing the best job they can, and they're always working in your best interest and making decisions that are best for you and your family. Critical. But then as we dive down a bit into the three elements of the liquidity strategy, the longevity strategy, which is long-term growth, and the legacy strategy, oftentimes we find the legacy strategy is of critical importance. And David Carter and I, and David Mietti and I have worked together for many years on the very specifics of the legacy strategy. What does that look like and how does it work? And I thought we'd begin with David Carter and his discussion on the basics of estate planning. What do you need? What documents should be in place and what documents should be updated regularly? And I think additionally, David, maybe commenting on what kind of communication should occur between, say, a client and an estate planning attorney, you know, the frequency of communication and what that looks like.
All right, sounds great. Can everyone hear me?
Yes.
Okay, I'm trying these headphones to see if I can drown out some of the other noise in the house, but let me see if I can share my screen here. Hold on a second and we'll see if this works. Okay, can you see that presentation?
Yes.
All right, great. Wow. Okay. So, you know, a couple things that Spence said. One of the most important thing I think he says is planning, and it's having a plan. And I always use this quote, and I need to get a better quote than this, but I love this quote. I don't necessarily love who it's from, but someone says, everyone thinks they have a plan until they get punched in the face. And that was Mike Tyson, right? We all think we have a plan, but so what I'm going to try to do here with us today is I want to get you thinking so that you'll take the next steps before that punch in the face comes. And what is that punch in the face? It's death. It's disability, it's some unforeseen circumstance, and it's the dreaded taxes, right? We have these taxes out there as well. So when I sit down with clients, there's kind of two roads that I go down with them. I talk about family planning and tax planning. And it's essentially what I try to get from them is, tell me a little bit about your family. Tell me what you would like to do. Tell me about how you're charitably inclined. And then I guide them, because most people don't know about the tax aspects of all of that. But from a global picture standpoint, I also always say, well, there's certainly some goals of estate planning that we should all have. Now, estate planning is not cookie cutter, and so it's different for every person. So it's really hard to do this presentation, but this is just kind of generally of what we're talking and what we're thinking about to get you thinking about estate planning. So one of the first goal is you want to make sure your intent is carried out, meaning that if something happens to me, I know where everything's going, assets, who's taking care of things, those types of things. You want to make sure that you're planning for the orderly disposition of that as well. As I like to say, is if something happened, one of these bad days, if I'm married and something happens to my spouse, I want to make sure there's no bumps in the road. I want to make it easy for myself, or make it easy for her, or make it easy for our children. The other goal should be tax planning, and certainly that's not something for you to worry about. People do worry about taxes. It's something for us to worry about, educate you. And there's really a couple of type of taxes that we'll briefly talk about, estate taxes and income taxes, and we'll talk about that in a few slides here. The other thing is part of estate planning is when you talk to an estate planner, it's always usually not good conversations. You're talking about death and other things. But the other thing is you have to be concerned about is, well, what happens if it's not death, it's a disability, or if I go into a long-term nursing home care, am I being provided for, or is someone assisting me, both from a health standpoint and a financial standpoint? The other thing, we all like to minimize expenses, right? And so I always tell people, and you'll hear me say this 2 or 3 times, having a plan in place is better than not having a plan in place, for the very simple fact that by having a plan in place, you're going to minimize expenses that it's going to cost you and ultimately your family. And lastly, a goal of estate planning should be peace of mind, right? You should be able to sleep at night. If you say something happens to me tomorrow, it's okay. I know who's doing this. I know who's going to work with Spence. I know who's going to work with my accountant. I picked my son as the trustee, the fiduciary, the executor, whatever you want to name them. And so I'm not worried about it. And so you can sleep at night is what I tell people. Does that make sense? Okay. And I don't know how much time I have, Spence, and I know Spence can talk as long as I can too. So we got to be careful here. We don't dinner's at what time, Spence? 7. So we got to get these people out of here way before then. Right? Okay. So what are some basic estate planning documents? And again, I'm going to talk about just the basic estate planning documents. We really have 5 documents. We have a will, we have a trust. A will and a trust, you could have both documents or you could have one or the other. We have what I call financial powers of attorney. It's easier to remember financial. In Ohio, they're called durable power of attorneys. But if I throw that word financial in front of it, everybody understands that. And then we have the 2 healthcare documents here in Ohio, which are called advanced medical directives. We have a living will and a healthcare power of attorney. Okay. And I'll go through these quickly. What's a living will? A living will is a document that says if I'm in this state, the definitional state we use here in Ohio is a permanent unconscious state. It's not the legal term, it's the one I like to use, a vegetative state. If you have a living will in Ohio, it says you want to die naturally, no artificial nutrition or hydration. You don't have to fill one out. This is preferential. You could have religious or other beliefs that prohibit you from doing this. Preferential document. The other one that I would like you to do, no matter what, is that healthcare power of attorney. The healthcare power of attorney just says if I'm incapacitated and I can't make a medical decision, physicians will always come to you for you to make a medical decision. But if you lack the capacity to make that medical decision, you are appointing an individual to make that medical decision for you. So do you need these advanced directives? We can go through this quickly. Are you married? Well, certainly your spouse couldn't make that decision for you, but what if you're not married? What if your spouse is deceased? Who do you want to make the decision for you? A healthcare power of attorney, a son, a friend, daughter, whatever it may be. So you need to have that document in place so you decide who's making that decision. Another thing on that is, does your family really know what your medical wishes are? In these documents, you can say certain things. You can say, for example, I never want this treatment, or I want this treatment because I'm a diabetic and please consider it. So there's more things you can add to this. It is a form that we use at Eastman as the Medical Association of Bar Association form, but you can put other things in there so that these individuals will know what your medical wishes are. As you probably know, if you're scheduled for a surgery, if you go in the hospital now, what's the first thing they ask you? Do you have a healthcare power of attorney, living will? I want you to say yes. So I want you to complete these so that if something happens, they know who's going to make that medical decision for you. And my last one's a joke. Are you getting older? Yes, we're all getting older, right? So it's the more likelihood that you're going to need these documents as you get older, and then someone will make medical decisions for you. So the other documents, so we talked about healthcare, now we need financial. These are lifetime documents, meaning you're alive, you need someone to do something for you. As I said, they're called durable power of attorneys here in Ohio, but I put that financial in front of it because everybody can understand that. It's a financial power of attorney is where you're appointing an individual to do something for you financially. Go to the bank, go to the house closing, write a check for you, be able to talk with your advisor at your direction. So do you need a power of attorney? Well, who has the ability now? You'll know in most cases, if you have an account in your individual name, no one can really access that account. So what if you're in the hospital, and so who's going to pay the cable bill for you? If you're married, that's easy, your spouse can, but what if you're not married? Or what if your spouse is in the hospital as well? So making sure you have that backup, a child, a friend, someone to be able to do that for you. Again, what if you become incapacitated? That's the example. Who's going to pay the cable bill? People do this all the time when they travel overseas, right? Mom and dad are going overseas to Europe traveling, and something pops up here in Ohio, and I need my son to do it. Well, he really can. Is he your power of attorney? Yes, he is. Well, great. We can have him do it for you on your behalf. I'll skip that. I don't want to take too much of your time. So those are what I call the living documents, the healthcare power of attorney, the living will, and the financial power of attorney. As I said, with all three of those, at least two of the three, the healthcare power of attorney, the financial power of attorney, every individual should have one. There's always going to be a circumstance that comes up that you're going to need that document. As far as the living will, that permanent unconscious state you want to die naturally document, purely preferential. Some people want it, some people don't. Okay. So putting those aside, now we have, again, when you talk to me, it's usually bad. The documents, what happens if I pass away? So at the very least, most people, again, as I said, when we sit down with clients, what recommendations we make for them is dependent upon their situation. It's hard to say you need this by talking over a seminar like this. So we just generally talk about documents, but at the very least, you should at least consider a will. A will is basically a document that says, if I pass away and there's an asset in my name, here's where I want it to go. And what else do you do in a will here in Ohio? You nominate an executor. An executor is the person who's responsible for marshaling the assets, as I call them, and getting them all together, paying your final bills, medical bills, funeral home. Maybe you have to close out some accounts and do some other things. That's the executor. And so maybe you want your son or daughter or friend, so you nominate an executor in your will. It specifies how taxes are to be paid, and then it provides for the distribution of your assets. So if you don't have an estate plan in place, let me back up by saying you probably have done some estate planning. And what do I mean by that? For example, if you have an IRA or a 401k, you probably named a beneficiary on that IRA or 401k. So that beneficiary says where that asset goes. The will doesn't trump it. That beneficiary designation trumps it. So that's part of estate planning. The will just says any other assets out there that are in my name alone that don't go somewhere on my death, here's where I want it to go. And it specifies where you want it to go. The other thing, if you have minor children in Ohio, is where we nominate guardians for minor children. So if something happens to mom and dad, and you have someone who's 16 years old, a child who's 16 years old in your will is where you nominate who you would like to raise that child. Okay, makes sense. So again, a basic document may be specific for your circumstance, maybe not. It's just dependent. Do you need a will? Well, what happens to your assets on death? Do you know if they go automatically to everyone else? If not, well, we need that will as a backup. If you don't have a will and there's assets in your estate, as we call it, we have this statute called intestacy or intestate succession. And the statute says where those assets go. So if you're married, it goes to spouse. If you're married and your spouse is not alive, it goes to children. If you don't have children, it goes to your parents. If not the parents, it goes to siblings and nieces and nephews. Some people say, something happens to me, I have no children, and my spouse is not alive. I don't want it to go to my brothers or my nieces, nephew. I want it to go to my charity. And so that's why we do that planning as well. So if you don't want a statute to dictate, you need to specifically lay it out in your will where you want those assets to go. And the other is, again, do you want to reduce costs? I just keep saying that, and I tell people that having a plan in place, even a will in place, versus not having it in place is going to save you money in the long run. It really will. And then again, going back to what I said, the goals of estate planning, having that peace of mind. So if you have a will and you know where all those beneficiary designations are, and you say, if there's any other assets left over, here's where they go pursuant to my will, you have that peace of mind that your intent is going to be carried out. So another type of document, again, dependent upon your circumstances, is what we call a trust. I tell people to think of a trust as a bucket. If the assets are in the bucket, it does a couple things. One, it avoids probate here in Ohio. And for the most part, there's some tax planning that we do, both estate tax planning and income tax planning. It's kind of a step up a little bit from a will, and that's just generally speaking, it's not specific. But basically think of it as a bucket, and you're doing this planning for some other purposes as well. The tax aspect of this, as you guys may know, we have these things called estate tax. We don't have an Ohio estate tax anymore. We got rid of it in 2010 or 12. I forget now, Spence, it's been so long. We got rid of the Ohio estate tax, but we have a federal estate tax where the exemptions are really high. The exemptions are $11.5 million per individual. We do anticipate, and I think Spence will back me up and Dave will back me up in this as well, that those exemptions are going to come back down here in the next 12 to 18 months. What they come down to, we have no idea, but there's certainly not going to be 11.5 million. They may be 6, they may be 3.5. We don't know. But as part of trust planning is what we do, is usually a part of it is we're doing some estate and income tax planning as well. Okay. Let me go back. So why do we use trusts? Well, it's certainly as part of it is that tax deferral. We're trying to do some minimizing of the estate tax, deferral of the estate tax, and elimination of the estate tax. But probably 90% of the trust planning I do nowadays is for not necessarily for mom and dad, because what we're usually doing with mom and dad is if dad passes away, it's there for mom. It's more of the planning for generational planning. It's for children. We're trying to do some things for children, good or bad. Good is, my children are successful, and if the money passes down to them, great, but I want to give them some protection. We have kind of asset protection here in Ohio. When mom and dad passes away, the trust becomes irrevocable, and the children get protection from divorce, bankruptcy, creditors, all of that type of thing. And the not so good planning, little Johnny is a spendthrift. If he got all the money tomorrow, I'm afraid that he would go out and blow it, right? Or, unfortunately, more that we're seeing as some sort of addiction problem. My daughter has a drug or an alcohol problem, and so we need to prolong that. And so that is usually 90% of the time now is we're doing some family planning with the use of trust. Good and bad of it. It's again good protection for the children, and also protection from that child who has a problem as well, that we're making sure that we keep that legacy going, because mom and dad worked hard for their money, and we want to perpetuate that for generations to go on. And so that's part of the planning process as well. We do a lot of it. Again, the hard part is, and let me back up a little bit. When we sit down to decide will or trust or a combination thereof, what most attorneys will do with you is they'll have you fill out usually a questionnaire, an estate planning questionnaire, to get a little bit of information about your family and a little bit of information about your assets. and then sit down with you and say, okay, tell me a little bit what you're trying to achieve. And then we put into it the tax standpoint when we get the family planning they're trying to achieve from them. And so again, you really can't say what works for me until you have that initial conversation. Just like financial planning or anything else, you got to get as much facts and circumstances about the client before you can make an educated recommendation for them for what's the best plan that is specific for them. So that's again a part of what is a trust makes sense for you or not. Do you need a trust? Again, these are just general comments. Does reduce expenses. We do believe that. Would you like to defer distributions? And what I mean by that is, instead of your children getting the money outright, we're going to hold it back for some period of time, or maybe in perpetuity to create that legacy for children. Or because my son's a doctor and I don't want to put the assets in his individual name, I want to keep it in a trust for him and get some protection here in Ohio. We do think it's easier on the family if it's in that bucket. There's less bumps in the road if something happens to dad, and there's certainly less bumps in the road if something happens to mom. It's already there. We can do some planning with advisors and other things that makes it really easy for the children as well. Some continuity for the family. Special considerations, I bring this up, and I unfortunately have to bring it up, is a lot of the planning we're doing nowadays, especially this family type planning, there's some circumstance in the family that we need to consider. A lot of the stuff we do now is special needs planning. We have a grandchild who's autistic, and we need to do some planning for that. These are really the only vehicles to do that is a trust, making sure you can plan for that child. And lastly is the peace of mind thing, right? Something happens. I know I set up this trust, and I know that where the money's going and who's going to stay in trust. And I worked with this advisor for 20 years, and they're going to be an advisor to the trust. And so there's going to be no bumps in the road for my family, and I can sleep at night. So that's it in a nutshell. It is basic estate planning. Again, whoever you use, what you want to do is make sure you have a plan in place. If you don't, sit down with an attorney, tell them what your goals are, and basically what they can do for you is recommend a plan that meets your specific needs. Any questions?
David, thank you very much. That was fantastic. David Mietti is an expert in plan giving, and David and I work very closely together almost on a daily basis with our clients, and very happy to have David join us. David and I spent some time last week talking about today in this presentation and really sharing some neat leading edge ideas that are out there. David brings, along with David Carter, some fantastic ideas to the table for our clients. But David, thank you for being here. And why don't we move on to your side of the presentation?
Sounds great. Thank you very much, Spence. And David Carter, you did a terrific job getting a lot of stuff out there in a very short period of time. So thank you very much for that.
Well, David, I know how estate planners can talk forever, so I had to cut myself. We can, right? We can.
Yeah, I usually stop when there's no more oxygen left in the room.
I tell myself, slow down, slow down. We enjoy what we do, and I think Spencer will say the same thing. When you enjoy it, it's just, oh, this is, in a great audience.
That's right. That's right. So I'm going to talk about charitable giving today, and I've got 3 parts to my presentation. The first part, I'm going to talk to you about the tax efficiency of charitable giving. There are very few things that are black and white in the world, but looking at charitable giving from a tax efficient point of view is pretty much not a black and white thing. Then I'm going to talk to you about leveraging your charitable gifts, giving more than what you're really giving away. And then finally, I would like to talk to you about charitable giving combination strategies. You may take 2 or 3 different kinds of other financial planning, estate planning, or charitable giving strategies, put them together to achieve even more benefit for yourself, your charities, and your family. Okay, 3 parts for today. So first of all, for tax efficient charitable giving. Now, before I talk about the specific elements of it, I just want to remind everyone about the tax deductibility. For income tax purposes, if you are giving away appreciated property, you're able to deduct up to 30% of your adjusted gross income to a public charity. If you add cash to that, you can deduct up to 50% of your adjusted gross income. However, if you were to give cash only, so not one share of stock, but all cash, you could deduct up to 60% of your adjusted gross income, except this year. So last year and this year, for cash gifts, you are able to deduct up to 100% of your adjusted gross income.
Mm.
And that was really designed to really stimulate the economy, address issues that are going on with COVID. There's a lot of need out there, and we really want to stimulate those who are generous to be even more generous. Okay. Now, in order to go up to the 100%, it has to be to a public charity, so it can't be to a private foundation. It's got to go to a public charity. It cannot go to a donor advised fund, because they want to make sure that the dollars actually get in the hands of people who are going to be doing good work. Okay, that's what's really designed to do. Okay, so that's the deductibility amounts for this year. Now, from a tax efficiency point of view, I don't know if there's anyone in the audience who is already retired and taking required minimum distributions yet from retirement accounts, but the most tax efficient gift is what's called a qualified charitable distribution from your retirement account. You can give your required minimum distributions up to a cap of $100,000. It's like a dollar for dollar write-off. It doesn't get any better than that from a tax purpose point of view. Now, we know that recently the RMD period was changed to age 72. However, for charitable giving purposes, it's still 70 and a half. Okay, so even though you don't have to take your RMD out until age 72, you can take it out for this qualified charitable distribution purposes, okay, at age 70 and a half. Okay, so that you should start there. If you're over 70 and a half, that's where you should start. Anything less than that is not tax efficient. Okay, so now let's assuming you either used that up. Oh, and by the way, that amount has nothing to do with your AGI. You can just go ahead and just do that. Okay, it comes off. So let's assume you've used that up, or you don't qualify, or you don't have a retirement account, or you're younger. Then the next most tax efficient gift is to give appreciated property, because the gain disappears. It goes with the property and it's gone. Many people do stupid things like just give cash, or they sell securities, etc., and then they write cash after that, and it's just not tax efficient. What is tax efficient is to give appreciated property. Again, from an efficiency point of view, you start with your highest gain and you work your way down. Okay, you get as much gain out there as possible. One thing you never want to do is to give a loss asset, because the gift that you make is the fair market value of the asset. So if you have an asset whose current market value is less than your cost, that loss disappears. So in the event that you really want to make a very large gift and you've used up all your appreciated property and you still want to give more, then by all means, sell those lost assets, realize the loss for your tax purposes, and then give cash. Okay. And then finally, again, the best gift, if you've done all of those, then the remainder would be cash. Okay, but in that order, because what you're doing in that order is you're elbowing out the IRS from the gift. Okay, by using the charitable gift on the retirement account or appreciated property, any embedded income taxes or capital gains taxes disappear with the gift. Okay, and I would say that's pretty much as black and white as it comes for tax deductibility purposes. Now, I'm not talking about things like artwork, which have its own like little peculiarities, or private foundations, etc. We're talking to a public charity here who is our host today. And so we'll be focusing our attention on giving to public charities. Okay, now part 2, let's talk about leveraged charitable giving. So if we were giving something to a charity and we want to really get more bang for our buck, get more value for our dollar, how can we do that? Well, I'm going to share with you a story. It's a real story. It happened in Rochester, Michigan. I've done a lot of these, but the one in Rochester, Michigan is really a delicious story, and I really want to tell that one to you. And this is a case in which a client wanted to make a gift to Rochester University. He had this dream of constructing a clock tower on the center of campus so that every co-ed could have a romantic moment at the clock tower under the moon. It was just amazing. And he was going to make this gift, $5 million to the university. And he thought he was going to give appreciated property because he came to one of my talks at one point of time. Well, at that point in time, I says, time out, let's stop. Before you make such a significant gift, let's make sure, as Spence said, we understand your purpose. What is your financial plan? How does this work? So that the gift is not done in context. So we looked at what the client had. He had lots of money. But one of the things that we found out that he had a $6 million municipal bond portfolio that at the time was generating a little bit more than 4% of tax-free interest. So instead of using appreciated property in making the gift, what we did instead was do a securities-based credit line draw. So we used the municipal bonds as collateral. We used a credit line draw. The interest at the time was around 2%, but he was making 4% on the municipal bonds. And so he was able to get his $5 million deduction, pay the interest on the credit line, and still pocket the 2% difference. So he didn't give up his assets. This was done in 2007. And I'm proud to tell you that credit line is still open today because he's made more money by retaining his assets and financing the charitable gift than he would have had he just made the gift directly. So if there's any development directors out there, let me tell you, if you're talking to anyone who's interested in making a charitable gift that's significant, please let us know. We can talk to you about financing that gift, because by financing it, your client may even be able to give you even more. Okay, so think about the financing. The second thing that I want to talk to you about is utilizing life insurance. There are folks who may want to make a gift in their estate, in their trust. They want to, to provide after they're gone, but they don't have as much as they'd like, or they have a hard time balance between making a gift to the family, making a gift to charity. Okay, so one way of really helping your charitable contribution, your charitable gift, and not freezing out your family in the process, is to make a gift using life insurance. So in this particular scenario, the charity can apply for the life insurance on the donor, and the donor would make a gift of the premium to the charity. Charity pays the life insurance premium. When the donor passes away, the charity gets the full death benefit on the insurance. The donor got the tax deduction for making the gift to the charity that you've used to pay the premium. So from a charity's point of view, I know charities want dollars today. Okay, I get that. But smart charities know they have to plan for the future as well. Okay, they have to balance between current giving and future giving, estate giving, giving in bequests. And utilizing life insurance is a way of getting that future bequest, number one, on a more guaranteed basis because you own the insurance. Okay, and as long as that premium is paid, you're going to get those dollars coming in. Hopefully you have a donor who pays you the gift every year, but in the unlikely event that they stop paying, you still own the insurance and you can reallocate other dollars and pay that premium if you want. Okay, so it's really a good way of securing a legacy gift. And from the donor's point of view, it's tremendous leverage. Okay, so I would encourage you, again, consider that as well. As a bit of an aside, charities have an interest in basically their top 10 donors. Now, you just can't get life insurance if you don't have an insurable interest. Like everyone on this call could get life insurance on ourselves. Okay, what better insurable interest than we have than on our own life? But you may want to consider thinking about getting life insurance on your top 10 donors. If the donor passes away, then their annual gifts are gone. Okay, so and that can affect you. So you may have an insurable interest on those top 10 donors where you yourself can get insurance on them. Now, they would have to apply for the medical and qualify and all of that. But the point is you have an insurable interest, okay, for your top donors. So think about that. They may want to be very cooperative with you. And actually, they may be willing to give you that gift of the premium anyway. Okay, if they're your big donors now, they clearly care about you and your mission. So why wouldn't they want to secure that going forward? Okay, so it's another way of talking to your donors as well. So that was my second part today, talking about leveraging the gift either through financing or through use of insurance. And then finally, I would like to talk to you about putting together combination strategies. Okay, where you may have different strategies that combine together, 2 + 2 = 10 instead of 4. Okay, and this is an example. The first case I'd like to talk to you about is something called a charitable remainder trust. This is a trust which pays to an individual over a period of time or their lifetime. And then whatever is left over goes to charity. Now, I'm not going to get into all the details on the numbers and how it works, but just think about it this way. Property goes into the charitable remainder trust, payments go to the individual, and at that individual's death or at the end of a period of time, whatever's left over goes to charity. Okay, that's a charitable remainder trust. People who utilize those trusts almost invariably fund them with appreciated property. They may have a concentrated equity position. Think of a big employer down there. You've got people who work for the company, have a lot of stock in that company that may have a very low basis. They'd like to diversify. They're afraid of the risk of holding a one security position. This is a nice way of making a gift. They can immediately sell that stock and diversify it. There's no tax consequences on doing that. They can get a charitable deduction for the remainder interest that goes to charity, and they receive a cash flow that comes back to them. So it's a really nice thing. But the one thing that people sometimes get hung up with is the fact that, it still doesn't go to my kids. It's going to go to charity, although I like the charity, maybe a little bit more is going than I would care, or I'm just ambivalent. I just can't balance in my head between my kids and my charity. It's a tough decision. And so you combine that strategy, use some of those cash flow to purchase life insurance inside of an insurance trust. This way, when you pass away, whatever's left over in the charitable remainder trust goes to the charity, but then your kids get life insurance to replace what went to the charity. Everybody wins in this situation. So that's an example of a combination strategy, utilizing life insurance, which is very useful in estate planning, for replacing income taxes, either through estate taxes or embedded income taxes and retirement accounts, or to provide liquidity. In an insurance trust, it's a very tax efficient way of doing it because it's not taxable in your state if you do it properly. But you're combining that with the charitable giving technique and addressing a financial planning concern, which is, taking a concentrated equity position and diversifying it. So do you see there are many different things happening over here? And so when you put these together, the sum is much greater than the individual parts. Okay. Then the next example I want to give you on this, I'll be able to turn it over back to Spencer. And I've done a lot of these this past year, like a lot. And that's for people who are looking at doing Roth conversions. There are people who have very large IRAs, very large 401ks, and it may be a significant portion of their net worth. Quite frankly, they have their home, they may have a little bit of investment assets, but primarily they have a lot in retirement accounts. Well, those are great assets for you to defer taxation as you're building your assets. They're designed for you to spend in retirement. But if your accounts are so big, what are you going to do? You're going to leave them behind. Okay, well, they're the worst assets to leave to your family because of the embedded income taxes. So what some people are doing is some people are doing Roth conversions, taking a portion of that IRA and converting it into a Roth so that it becomes tax-free. Well, when you do the Roth conversion, you're going to have a very large tax year, very large year. So we take that Roth conversion strategy and we combine that with another charitable trust strategy called a charitable lead trust. Think of it as being the opposite of the charitable remainder trust. The charitable lead trust will pay to a charity for a period of time, and whatever's left over goes to the family. So it's a really nice way of providing a future gift to the family, providing a cash flow to a charity that they can depend upon, and getting a charitable deduction now that you can use to partially offset the income tax hit that you're going to have by doing the Roth conversion. Now, this strategy works also very well for any client who has a large income tax year. So either they're exercising stock options, maybe they're selling a business, they have just some big year where they need this year a big tax deduction. A charitable lead trust is a wonderful way of getting that charitable deduction, providing for your charity, and also providing for a future gift for the family down the road. Now, as David Carter will attest, I could go on all day about these strategies, okay? And Spence knows that I can do that too. I'm not shy. But I'll turn it back over to Spence now. My purpose today was just to wet your whistle on these topics. If any of these things apply to any of you or anyone that you know, get in touch with Spence and we're here to help. Spence, back to you.
David, thank you very much. Two quick questions. One item, Rashmi had a question, assuming when you began your presentation, David, that by this year you meant tax year 2020. Is that correct?
I meant well, it's 2020 and 2021, both of those years.
Okay.
So 2021 as well, yes.
Right, both years. Secondly, one thing that David and I have been working on over the last year is, and what might resonate with your members is, you have individuals who have required minimum distributions from their retirement accounts. And in many cases, we have clients who don't need the required minimum distribution, but unfortunately, they're forced to take that. Now, of course, due to the CARES Act, required minimum distributions were suspended last year in 2020. However, 2021 and forward, required minimum distributions are reinstated. And so what we're finding is clients say, well, I don't need this required minimum distribution, but I know I have to take it. Furthermore, I'm taxed on this distribution. And it can become actually, frankly, a frustrating and stressful decision, because in many cases, clients have worked very hard to accumulate assets within their retirement accounts, but the government has come in and has said, okay, you now have to take distributions regardless of your need. And on top of that, you need to pay taxes on your distribution. Whether or not you want to pay taxes, you still need to pay taxes. And so, David, can you share perhaps with the group, how perhaps their members could have some dialogue about gifting part of that? Perhaps you could share some examples we've worked on with clients to more effectively utilize the required minimum distribution for either gifting purposes, say to the Hindu temple, or to a university or a charity or others, because I think this is very important. The required minimum distributions are not going away. And in many cases, our clients don't need the required minimum distributions for income purposes. They have to take them. And what we spend a lot of time on is ensuring that the utilization of that distribution is maximized, that the purpose is maximized, rather than just taking the distribution and putting it into a bank account. There's not a lot of need. So maybe if you could share with the group, David, an example or two of how that could fit into gifting to the temple or another organization.
So one thing to consider, to look at your members, okay, and look at your members who are age 70 or older, okay, so you get that universe, okay, and educate them on this. If your members are already making significant gifts, it's that qualified charitable distribution directly from the IRA to the temple up to $100,000 is the most tax efficient way of doing it. So if your members are already writing checks to you for, I'm making this up, $50,000, but they are over 70 and a half and they do have IRAs, you will do a great service to them to tell them you're doing it the wrong way. We appreciate your gift, but let me help you give it any more tax efficient way for you. Okay, it opens up the conversation for that. Okay, during that conversation, they may decide to give you some more out of gratitude for telling you that. Okay, so every conversation is a good conversation to have with that. Another thing that you can do with that required minimum distribution, if they make the gift to you, maybe that could be earmarked for life insurance that you own. Or maybe it could be utilized for life insurance for the family, and then they can name the temple as the beneficiary designation of the retirement account. That's the best estate gift to charity, is to make a retirement account a beneficiary designation to the charity, because the estate receives both an income tax and an estate tax deduction. Most people give the wrong assets to charity in their estate. They leave the IRAs to their kids and they give other assets to the charity. It should be the other way around for tax planning purposes. So again, if you're talking to your donors, to get to Spencer's point with these retirement accounts, there are many different things that you can do with them from a tax efficiency for charitable giving. Either the qualified distribution directly of the RMD to the charity, or the beneficiary designation of that for an estate gift. Okay.
David, thank you, David. There was one question on the group chat. Did I hear you saying a church can buy life insurance on donors or its members?
On its key donors. Okay, so think in terms of your top 10. Okay, this is a conversation to have with your insurance, carriers and your insurance folks. Okay, because it's the insurance company who has to determine whether you have an insurable interest. Okay, you just can't get insurance on anybody. Okay, and so if you have your top 10 donors, and I'm making this up because I don't know. Let's say your top 10 donors each give you more than $100,000 per year. That's a significant hit if that donor is no longer alive. And that gift is gone, okay? It can have a tremendous effect on your institution. So in that respect, you would have an insurable interest because you are insuring the loss of that gift, okay? So the death benefit is generally 10 times the average annual gift, okay? So if they're giving $100,000 per year, you could probably get $1 million worth of life insurance, okay? But it's not on everybody. It's going to be on your top gifts.
That's great. Another question for individuals who do not itemize deductions.
Mhm.
Is there a limit on the charitable donation that they can deduct for this tax year, 2021?
No, I mean, unless you itemize, doesn't matter what you're giving, you can't itemize. Okay, so it really only matters if you itemize. Okay, now there are some folks who give a significant amount, but not enough to itemize. So there is a combination strategy of making let's say 5 years of gifts, as an example, into a donor advised fund. That's a public charity. You've given 5 years worth in 1 year. You now have enough to get your charitable deduction, and then out of the donor advised fund, you can dole it out to your charity over time. So you don't necessarily have to give the institution 5 years worth of giving all at once. You may not want to do that. And most people want to make sure everyone earns their gift on an annual basis. Okay, but that's right. We want to earn it, right? And so that's a way of putting the money out there, getting your deduction, because you know you're going to give it anyway. Okay, that's called bunching. That strategy is called bunching. It's very helpful to utilize with a donor advised fund. The other thing with the donor advised fund too, and I don't want to take too much time, but think in terms of a donor advised fund as being a way to separate the giving decision from the granting decision. Okay, the giving decision is a decision you work with your tax preparer on. Your tax preparer is going to say, this is your estimated income this year. This is how much you can give to public charities, etc. You say, okay, I like this amount. I want to give this amount, but I'm stressed out. I don't know who I want to give it to. We'll separate the decision. Okay. If you make the gift to your donor advised fund, you now have, you've completed your charitable gift, and then you can decide for another day the ultimate charities where you want it to go. Okay, so that's what I'm saying, just separating the giving decision from the granting decision, because when clients try to do both and they're not ready, then they don't give at all. Okay, and so this is a nice way of actually getting them to gift and taking the stress off the table for the ultimate donor.
Hey, Spence, in 2020, if you did the standard deduction, you still get a deduction on the first page for charitable contributions. I think it's $300 individuals, $600 couple. I don't know if that went to 2021 or not, though. But so that was the bonus of trying to give people relief.
Right.
Good point, David. Thank you.
Mhm.
David, I have a question.
Mhm.
Sorry, my video is off. This is Rashmi Agnihotri. So I heard you say earlier that the temple could possibly consider buying insurance if they have an insurable interest on their key donors.
Yes.
So, and then you also said that donors could be altruistic enough to help pay perhaps part of or all
Yeah.
of the premium that on
Yeah.
that insurance. Now, would that premium be tax deductible for the donors?
Yes.
Because if they just donate it to the temple, obviously they get the tax deduction. But if they pay the premium, then
Well,
what?
no, we don't want them to pay the premium. No, we'll take whatever they'll get, right? We'll take whatever
Right.
they get. But it's better if the insurance is owned by the temple,
Uh-huh.
they make the contribution to you and you pay the premium. That's the most tax efficient way of doing it.
Sorry, come again?
So the temple buys the insurance.
Uh-huh.
The donor makes a charitable gift to the temple, gets the tax deduction, then you
Gotcha.
use those proceeds to pay the premium.
Gotcha. Okay. Okay. So it's
Okay.
kind of like an earmark thing that they can,
Yes.
yeah. Okay.
Yes.
Got
Exactly.
it. Okay.
Yes, yes.
Thank you.
Yes,
That helps.
and it's up to you to make sure you've got the insurance, right? And so they're going to make the gift, they get the deduction. But if for whatever reason, let's say your donor moves out of town, they're no longer here anymore, they're no longer a member. Doesn't mean they don't love you, but they're just not a member anymore. Okay. Well, you still own that insurance.
Right.
Okay. So you can look at your budget and say, we need to come up with some dollars here because if we don't pay this premium, it's going to be gone. Or what you could do is you may be able to what's called a 1035 conversion of that insurance into whatever a paid up policy would be. Okay. So
Gotcha.
maybe you had a death benefit of $1 million, but maybe if you want to pay no more premiums, you'll get a death benefit of, let's say, 250,000. Well,
Gotcha.
you'll take that if you don't have the money to pay the premium.
Excellent.
Okay.
Thank you.
You're welcome. You're welcome.
Well, Dipti, thank you so much. Any other questions? Please, I'm sorry.
Bhupesh, I have a question. So, talking about living well, do we need to have both, or if you have the healthcare power of attorney, does that also cover the same as what the living will does?
I think I was having problems hearing your question, but you don't need to have both documents. Actually, in your healthcare power of attorney here in Ohio, you can delegate the authority to your power of attorney to make that decision for you, to make that decision if you want to withdraw artificially nutrition or hydration. But if you say, I don't want them to make that decision, meaning that it's a child and you don't want to put them in the position, but if you're in a permanent conscious state, you want to die naturally, I tell clients to fill out a living will so the doctors will follow that. You don't have to rely upon your healthcare power of attorney to make that decision for you. But you can put that in your document. You can initial a box that basically says, I give my healthcare power of attorney the ability to make that decision on my behalf.
Okay. Is there a government website where forms are available, or do we need to actually engage with a firm like yours to make those documents?
No, actually, as I said, I'll be very honest with you. We use the Ohio Bar Association and the Ohio Medical Association's healthcare power of attorney and living will. Some firms use their own, but we use those because all hospitals are familiar with them. And so it just makes it easy. So I think you can go on the Ohio Supreme Court website and or the Ohio Medical Association's website and get the healthcare power of attorney and the living will. And they're pretty easy to complete, really good instructions.
Thank you. I have one more question. For donating appreciated property, so let's say I am under 65 and I have appreciated property that I want to donate to the charity. And what is the limit? How much do I need to actually donate so that I can actually take a deduction for it? Or would it always apply? Would the capital gains even go even if I do not itemize because I am donating it to the charity?
Yes, it doesn't matter whether you itemize or not. If you're giving a gift of appreciated property, there's no recognition of that gain.
Okay, got it.
If you make a large gift and you're not able to deduct all of it in the current year, there's a 5-year carry forward. Okay, so you basically have the current year and 5 years carrying forward to make sure you use all the deduction. So that's why it's very important from a team approach to work with your tax advisor to make sure that you don't have too much deduction that you can't use.
Okay.
Okay.
Got
it. Someone asked about no estate tax in Ohio, and that is correct. There is no longer an estate tax in Ohio. That's wonderful news.
I think from the finance committee standpoint, that's where this conversation came about. We want to make sure that the community and the members of Hindu Temple understand the planned giving approaches which are beneficial to the temple as well as to them individually. And this discussion has been very helpful in that regard. And I think we can carry on this discussion in the future with the community members in small groups to see who can do what, you know, because there might be the areas. Another area which I don't think David talked about was the what we call as a planned giving by annuity. Do you have something like that where somebody can have the planned giving by donor advised? It's called charitable gift annuity. And I have seen some organizations do that where the older people can get the income every month.
Yes.
And at the end, the charity also benefits, or even during the years when they're getting the money from their gift to the organizations, they're getting the income they need to survive or to, you know, supplement what they're getting, you know.
That's correct. A charitable gift annuity is really designed for the smaller donor. A donor who wants to make a gift but doesn't have enough to do a charitable remainder trust, for example. Okay, and a charitable gift annuity is something that you can also pool assets to make those payments. So it's really a very nice way for a smaller group, let's say, to take a CD and reposition a CD. Okay, they can make the gift to you, they can get the cash flow, the annuity payment back from you, they'll get a charitable deduction as well, and then you have the proceeds of that. So yes, and it's really, think of that as being a charity's version of like a retirement plan. Okay, that's kind of like what it is. It's people making contributions to that so they can get a cash flow back, and the ultimate assets, go to the charity.
Yeah, that's something which might require some explanation, because it's difficult to comprehend for individual how the money comes back to them from the organization,
Right, right. And it's very challenging to start up a charitable gift annuity from scratch. You need to have, enough dollars coming in there just to make it worthwhile, because it's expensive to run. If you only have one of them and it's $50,000, you're going to spend more in accountant's fees making sure it's all taken care of than you're actually going to get a benefit from it. Now, this is something I don't know, so I'll just throw it out there that maybe someone in the audience could know or find out. But maybe there'd be a way of you to get a charitable gift annuity through a consortium of organizations. Maybe there's other temples that you could join together and become part of, one larger charitable gift annuity group. I don't know, I'm making it up, but ideas always pop in my head, so I don't always have the answers, so I'll get you an idea on that one. But it's worth looking out to see if you can join it. In a way, it's sort of like, I don't know, a credit union kind of a thing. Maybe there's just a group of institutions that can provide that together.
Okay, yeah, we can look into that.
Mm-hmm.
I got a question about donor advice fund.
Yes, sir.
Regarding required minimum distribution.
Yes.
If I contribute to donor advice fund, I had to pay tax on it rather than if correct?
That's correct.
Tax.
That's correct. The donor advised fund specifically does not qualify for the the
RMD.
qualified- Yeah, for the IRA distribution. It's specifically exempted because the donor advised fund, although it's a public charity, it's not an operating charity. Okay, and the government wants that gift. They're going to give you that dollar for dollar write-off. They want that gift to actually go into the hands of someone who's going to be doing something like the temple.
Whereas the qualified charitable, you get the considered as a RMD
That's
distribution.
correct. That's correct. Up to $100,000. That's
Yeah,
correct.
thank you.
Mhm. Thank you.
One more question from Rashmi.
Okay.
Does the temple need to set up the ability to accept appreciated stock, for instance, or can that be handled through a third brokerage firm or whatever and do it? I mean, do we need does the temple need to have its own ability? Because I know I donated appreciated stock way back in the past, but we had to handle it through outside, and then, you know, kind of, I got the full benefit, of course, of the appreciated stock from my charitable deduction, but the temple did not handle it. It was
I can
handled.
answer, Rashmi, this is Rajesh Longani. Let me answer that question because we
Okay.
are doing it now. If everybody, I don't know if everybody received the letter that we sent out along with the tax letters on February 6th. Raju, Bhupesh, and I worked on that letter. That was something that was mentioned in the letter and also mentioned by, I believe, David just now. We are doing it. There are members that have been doing it every year consistently. Rashmi, you can do it now at any time because there is a set process.
Good to know.
And anybody from the finance committee will be able to help you. Ask Raju, ask me, and we'll be able to guide you on that because we're doing it now.
Good.
Okay, thank you, Rajesh.
Okay.
Raju, if you're speaking, you're on mute. We can't hear you. I see your lips moving.
I was just saying that we can take care of it. If anybody has any questions about giving the appreciated stock, I think the UBS has a procedure and we can help you with that and get it done for you.
Mhm.
Yeah, we have been doing it for the past few years. We have done it. Yeah.
Right.
Now, even when I was the treasurer, we have taken care of that. So.
I think somebody can thank.
Yeah, if there are no other questions, Bhupesh, I'll let you go ahead.
Sure. Thanks, Dipti ji. It was very informative, this session. Thank you to Spencer and David Manatee, as well as David Carter, for
Thank you.
taking time out and sharing this information with us. And thank you, Dipti ji, for coordinating and making this event possible. Much appreciated.
My pleasure, and thank
Thank
you
you.
very much to the speakers and all the people who attended, and the ones you didn't attend. Well, you lost out, I guess.
Well,
Good job.
we'll share the recording on a YouTube channel for them.
Thank you.
Nobody loses. Everybody wins over here.
All right. Well, that's our, yeah. Okay.
This
All
was
right,
in
good job.
for almost a year. And
Thank
I'm glad
you.
it worked out after 1 year, you know.
Yes.
Yeah.
We had planned to do this last year, and then because the COVID had other plans. So, yeah.
Spencer, you're on mute if you're saying something.
Yeah, thank you again for including us. We're honored and grateful to be part of this. Thank you.
All right. Thank you. Thank you.
Thank you. Bye.
Thank you.
Take care. Bye-bye.
Bye-bye.
Bye.